Okay, welcome back to Accounting 101, Chapter 3, the adjusting process. Um, the generally accepted accounting principles require that we follow what is called the accrual basis of accounting, ACCRUAL, not CRUEL, versus the cash basis. The difference is the cash basis, you would record revenues and expenses when payment is made or received. With the accrual basis, we are going to not record revenues and expenses when payment is made or received, but rather when the revenue is earned or the expense is incurred, regardless of when payment is made. Payment can be made prior to, at the time of, or subsequent to. Okay, and we've seen this a little bit in the first two chapters with the example the authors used with Smart Touch Learning of, I believe the law firm paid Smart Touch Learning to do some training. So they got paid before they did the training. They got paid before it was earned. And in that case, we debited cash for I believe it was $600 and credited unearned revenue, which is a liability account, not a revenue account. Now, when Smart Touch Learning does perform the training in whole or in part, we have to adjust that account unearned revenue to recognize the amount of revenue that is earned. What happens oftentimes, we have revenues earned or expenses incurred in one period, 1 year, and payment occurring in the subsequent year. Now, again, we have to go back to the logic behind this, or the rule, and that is the matching concept, where we want to get the revenues and the expenses in the year when both of them were incurred or earned. That gives us a better measure of income, even if we have to do a little bit of estimating, give up a little bit of accuracy. As ridiculous as it sounds, it does a better job of matching, putting the expenses in the proper period of which they generated the revenue. So if we use estimates to preserve the matching concept, it's counterintuitive, but it works. Okay. Bear with me while I try to navigate this e-textbook. And first topic I see is what's the difference between cash basis and accrual basis? The first big heading. Oh, come on. All right. Again, the cash basis records only transactions with cash receipts, cash payments. And again, I January 15th or whatever, I don't know if that was a weekend or not, I had to, let's see, the 15th was a Sunday, so on Monday the 16th, I had to send in my fourth quarter 2022 estimated tax payment. So that's a tax expense from 2022 that I made in 2023. Just give you an example. Cash method is easier to follow because that's how we live our lives. We get paid, we cash our paycheck, we pay our bills, write checks out. There are times, and we'll see this later in this chapter, there are times when we have certain things we have to adjust for, and they almost always result in a revenue or an expense account is involved in the transaction, meaning we either have to convert a asset, reduce an asset for the amount of asset that has been used. We'll see how that works. A lot of prepaid items, office supplies, and the like. Depreciation for fixed assets, which you don't know what they are. That's chapter 9. And expenses that have been incurred but not yet recorded. Those are the tough ones. And the classic example of that is a accrued expense. Okay, and we'll get to those. And I'll put you'll see it in the highlights, you'll see it in the PowerPoint, so I'll also demonstrate it here. Again, the accrual basis records the effect of each transaction as it occurs. Believe it or not, there are 5 or 6 criteria to recognize revenue. About 10 years ago, the FASB elaborated on criteria you need before you can record revenue, because there was a lot of abuse and interpretation. So they expanded the rules and cleared them up. So the basic rule is you record revenues once you earn them, not when you get paid. Again, payment can occur before, during, or at the time of sale or after. Okay, they give us an example here of May 1st, Smart Touch Learning paid $1,200 for insurance for the next 6 months. Well, that's a prepaid expense, so it's an asset, obviously. Now, with the passage of each month, part of that, 1/6 of that payment, or $200, gets used up and gets used up or consumed. So at the end of May, at the beginning of May, we had an asset worth $1,200. At the end of May, we've used 1/6 of it up, but the account is still showing a balance of $1,200. So if we're doing financial statements, we have to do an adjusting entry to report the fact that we have used up 1/6 of that asset, or $200, and we have to transfer it from the asset account to an expense account. Now, that doesn't seem like a whole lot. And again, the only way you can, the way we do adjusting is we have to write a journal entry. That's the only way you can put something into or take something out of an account. And we'll get into that shortly. But the important thing there to realize is when it's a prepaid insurance, an asset, it belongs on the balance sheet. If we don't do the adjustment, we're overstating our assets, which is a big no-no. Violates the conservatism principle. Also, if we don't do the adjusting entry, we are understating our expenses. So our balance sheet is going to be off and our income statement is going to be off. Now, notice I mentioned 2 different financial statements: the balance sheet, assets overstated; income statement, expenses understated. We don't want that. We want to try and be as accurate as we can within reason. So the thing to note is, with a lot of these, or if not a lot, but all of these adjusting entries, some of the accounts sound very similar. Unearned revenue. A lot of students say, oh, it's a revenue account because it's got the word revenue in it. Well, with the word unearned in front of it, it's actually a liability account. And we have to, as we earn it, recognize how much we've earned. Okay. The big important thing here to realize, other than doing the specific adjusting entry we need to do to get the accounts properly stated, to have the proper balance in them, is, in this case, prepaid insurance, we're taking something off the balance sheet and putting it on to the income statement. That's the important thing, is that we're changing the nature of it. It's going from an asset account to an expense account. Now, keep in mind, take a step back and let's figure this out. Prepaid insurance would be a current asset up on the top of the balance sheet. We take part of it, we do the adjustment for how much we've used with the passage of time. It goes over on the income statement, filters down into net income, goes to the statement of retained earnings. We get the end of year or end of period retained earnings, and that comes back to the balance sheet, but where? On the bottom of the balance sheet. So it works its way. Its journey takes it from an asset on the balance sheet, works its way over and filters down the income statement, and then gets transferred back to the balance sheet, but in the form of retained earnings, which is an equity account. Remember, early on, we saw the modification of the accounting equation, where assets equal liabilities plus equity. And I had that little 3-prong thing for the equity, saying that's increased by revenues, decreased by expenses, and decreased by dividends. Well, this is a manifestation of that, where that revenue or that expense is coming over, filtering down, and then getting over back to the balance sheet, but on the bottom of the balance sheet in the equity section, specifically in the retained earnings account. Excuse me. So if Smart Touch Learning prepared statements every month for the next 6 months, they would do that journal entry. And now again, prepaid insurance is an asset. It's normal debit balance. So to reduce it, we're going to credit the asset for $200. Where does the $200 corresponding debit go? Obviously, insurance expense. Okay. So they walk you through that in the textbook there, using that example. And let's see, what's the other one here? Okay, next example, they give us April 30th, Smart Touch Learning received $600 for services to be performed. It's very important with the adjusting entries that we pay attention to the tense of the verb. To be performed, meaning in the future, meaning we haven't done the work yet. So we're not entitled to record the revenue. So we have to set it up as a liability. The original entry there would have been debit cash for $600, credit a liability unearned revenue for $600. Now, the services are covering the next 6 months, May through October. So at the end of May, what do we want to do? We want to record the fact that we have now earned 1/6 of that contract or that agreement of $600 payment. And we're going to reduce the liability because we fulfilled it. So we're going to debit unearned revenue for $100, 1/6 of the 600, and we're going to credit service revenue. So we're taking it from a liability account, reducing that, increasing a revenue account. Because the passage of time, we have earned it and we can now record it. Let's see, they have a try-it example here in the ebook. Total pool services earned $130,000 of service revenue during 2024. Of the $130,000 earned, the business received $105,000 in cash. The remaining amount, $25,000, is still owed by customers. So that would be in the accounts receivable. Okay. In addition, total pool services incurred $85,000 of expenses during the year. As of December 31, $10,000 of the expenses still needed to be paid. So that would have to be a liability. In addition, Total Pool Services prepaid $5,000 cash in December 2024 for expenses incurred during the next year. So that's prepayment. So determine the amount of service revenue and expenses for 2024 using the cash basis of accounting. I wouldn't do that. Determine the amount of services and revenue and expenses for 2024 using the accrual basis of accounting. Yeah, maybe I will do it. Let me pause the tape so we don't have dead time here. And I will do them both. I'll get a paper and I'll do them side by side. Hold on. I'll be back. Maybe not in a jiffy, but I'll be back. All right. Quick, so excuse my penmanship. But what we have here, based on what they told us, on the cash basis, it said, well, accrual basis, they say, let's say we earned $130,000 as service revenue. Okay, of the 130,000 earned, all of it's going to be counted under the accrual basis. But they said the business received 105 in cash. So we're going to only pick up the cash under the cash basis. So the difference there is in revenues, $25,000 less on the cash basis, 25,000 more on the accrual basis. So right there we have a difference, significant difference. Okay, the remaining 25,000 still, that's in receivable. So we would, over here we would have a revenue, accounts receivable debit for 25,000 and service revenue credit for 25,000. On the cash basis, we wouldn't have any journal entry for that amount that's in the still owed by customers. We wouldn't have receivables because it's a cash basis. In addition, total pool services incurred $85,000 of expenses, incurred $85,000, and it said over here $10,000 still needed to be paid, so they're in accounts payable. No cash went out, so I reduced the $80,000 by $10,000, and then it said we also prepaid cash expenses for next year. Well, over on the accrual basis, that prepayment would be an asset. Over on the cash basis, it's a disbursement, so we record it when we made the payment, even though the expenses will not be incurred until next year. So the expenses are increased by 5,000. So the difference is 20,000 between the two net incomes, 25,000, 45,000. There's the reconciliation. Revenues are off, are more under accrual basis for the ones that haven't been collected yet, 25,000. And excuse me, I'm looking at this backwards in the screen, or the other way to say it, cash collected on the revenues earned is only 105 or 25,000 less than it would be recorded under the accrual system. And then the expenses were 10,000 less, 85,000 here, paid in cash and also in liabilities, accounts payable. Here we're only doing the net amount of cash paid, the 85,000 less 10. And then we have to add in the 5,000 prepaid expenses because we're on the cash basis. All right, hopefully that is a little bit of a clarification of that or an example of that. Try it. So, come on. Then they refers. There's the video here. I gotta go to the next page. Bear with me. Okay, a lot of this, the accrual basis versus the accrual basis of accounting, it has to do with the timing of payment. Okay, now one thing is adjusting entries will never involve the cash account. They will involve an asset account, usually some type of prepayment or accumulated depreciation, an expense account, a revenue account, or a liability account. But they will never involve the cash account because cash is already been exchanged or will be exchanged at some point in the future. Oh. It takes so long. I can turn a page faster manually in a book than I can electronically. There's a couple things in life that bother me, and one thing I can't stand is electronics that take a while. My wife has a 2019 automobile, and because of the electronics in it, when you start the car, it takes 5 to 10 seconds for the radio to come on. My 8-year-old Buick, as soon as I start it, I can do anything. I touch the radio, it comes on instantaneously. That's progress? I don't know. Okay, they give us what I was talking about over on page 3-5, revenue recognition principle. They give us the updated stuff from about 5 years ago with the FASB. What are the 5 steps? Yeah, 5 steps there. Identify the contract with the customer. identify the performance obligations. What part, what do we have to do in order to earn it, to claim it as a revenue, determine the price, and then allocate the transaction price to the performance obligations in the contract. Recognize revenue when or as the entity satisfies each performance obligation. Again, basically, you can't recognize the revenue until you earn it, regardless of the timing of payment. Okay, the batching principle, we discussed that at the beginning of the video, and its expenses are recorded when they are incurred. Expenses are matched against the revenue of the period. Okay. What are the adjusting entries and how do we record them? Well, we write them in the general journal following the same rules. Account being debited is written first, right up against the left-hand margin. Accounts being credited are written below the account being debited and indented slightly to the right. Okay, same rules of debit and credit apply. We have to identify what the type of account involved is. Accounts are, oh, come on. Come on, get back. Okay, here we go. Oh, this thing is unbelievable. Gotta wait through. Oh, geez. It just went back 2 pages on. All right. Yeah, stay there. Okay. Usually, what we need to do, how to zero on whether an account has to be adjusted, is by looking at the trial balance and analyzing line by line and asking ourselves, does this balance need to be adjusted? So there are certain things to look at. Okay. We'll walk through those. They give us a trial balance called Exhibit 3-1. Now, cash, again, is never going to be adjusted. Okay. Accounts receivable, probably not. Office supplies. Now, think about that account called office supplies. During the year, we bought office supplies either for cash or on account, and we debited the asset called office supplies. Now, what is happening throughout the course of the year? Are they just sitting there collecting dust, or are employees using the supplies? So that's an important word, using, because if we use an asset, we're consuming it, its value is diminishing. So as people use pens, paper, a printer cartridge, staples, paper clips, those supplies are being reduced. The asset office supplies is being reduced. So we have to reflect that. The way we do it with office supplies is we go to the office supply cabinet or cupboard or closet, wherever we keep them, and we do a little inventory. And based on our invoices from our vendors, we can approximate what we have on hand. That will usually be different than what we have as a balance in the account called office supplies. The assumption is the difference between what's in the account and what's actually on hand is what has been used up or taken by the employees and used in generating revenues. So we need to reduce the asset, office supplies, and increase an account called supplies expense. Okay. Prepaid rent. Yeah, whenever you see an asset with the word prepaid in front of it, you better analyze it and see if any of it has been used up. When was the when was the disbursement made? Notice I said disbursement, not expense. It's an expenditure, but not an expense. When was it made? look at the contract. What length of time was it for? How much did we pay for it at the onset? And then figure out how much of it has been used up or consumed with the passage of time. And then just work it out, and then reduce the asset by whatever we figure it out to be, and increase the expense. And when you have a prepaid thing, whether it's prepaid rent as here or prepaid insurance, it just goes to a rent expense or an insurance expense would be the debit. The expense would be increasing, the asset decreasing. The thing I would caution is, again, we usually do this on a month-by-month basis. Be careful of not only the month, but the date. If it's the end of the month, June 30th, then you got July, August, September, October, November, December, 6 months. If it's June 1st, then you count June. Okay, so if it's the beginning of the month, you count the month. If it's the end of the month, you don't count that month. Land usually won't be. Buildings will have accumulated depreciation. We'll get into that. Furniture. Accounts payable, no, unearned revenue. We'd have to look. Hey, we have this liability, unearned revenue. Did we earn any of it? Then we'd have to convert to a revenue account, taking it from a liability balance sheet account and putting it into a income statement revenue account. Common stock, dividends, usually not. So then some of the expenses. Here's the tricky part with accrued expenses. Some of them we'd have to see, or maybe not even see in the trial balance, and just be aware that there's something that has been an expense that has been incurred but not yet recorded. I guess would be the best way to state that. Here they give us as example office supplies. We talked about that. They had $500 in the account, but it doesn't say how much we used here. Okay, they're going to get into, there's 4 types of adjusting entries listed there on page 3-7. Deferred expenses, deferred revenues, accrued expenses, and accrued revenues. Okay. I've said many times, accountants are reasonable, practical type of people. We tend to give names that are descriptive, indicative of what the thing is or does. And the word deferred, how do you interpret that? Deferred, push off to the future. Accrued, it has accumulated from the past. Okay. And again, it only affects revenues and expenses. Let me see if the book has this. If not, I will again stop the tape and yeah, let me stop that because they don't do it the way I do it might supplement what they do. Hold on, I'll be right back again. Oh, shoot. Oh, I guess I didn't click on that. So you got a nice shot of me writing this thing down. Okay, it's easy. Revenues and expenses going across, deferrals and accruals coming down. Deferred revenue. Payment received, but the goods or services have not yet been delivered. We haven't earned it. We've gotten paid before we've delivered. Accrued is just the opposite. We earned it, we delivered the goods or services, but we haven't been paid for them yet. Expenses. Deferred expense, that would be like your prepaid items or your office supplies or a fixed asset that we're going to depreciate. Paid for before we incur it. Accrued, the expense has been incurred, but we haven't paid for it yet. So we'll see how those play out shortly. Oh, sorry about that dead time. Okay, the first example they give us is prepaid rent. Smart Touch Learning prepaid 3 months rent. And then back in chapter 2, transaction 10, that was on December 1st, 2024. $1,000 a month, 3 months for $3,000, December 1st. So it's going to cover December, January, and February, 3 months. 1,000, 2,000, 3,000. Payment made December 1st. So this is a deferred expense. We paid for it before we incur it. Now at December 31st, end of the year, we're going to prepare financial statements. So you prepare adjusting entries whenever you're going to be preparing financial statements. So we have a trial balance at the end of the year, and we go down and we say, oh, prepaid rent. That was for 3 months. 1 month has come and gone, the month of December. So we need to reduce that asset by $1,000 for the month of December rent. December 31st, we don't have 3 months worth of rent prepaid. We only have 2 months remaining, but the account shows 3 months, $3,000. So we have to reduce that by $1,000 for the rent that was incurred during the month of December. So you're going to write an entry to reduce the asset. So credit prepaid rent by $1,000. You got to have a corresponding debit because debits and credits have to be equal. The account being debited will be rent expense. Rent expense debit for $1,000, prepaid rent credited for $1,000. So the debit increases the expense account, the credit reduces the asset prepaid rent. After we post that, and again, just like any other entry, we're going to write it in the general journal, and then we're going to post it to the general ledger account. And after we do that, that prepaid rent account will have a balance of $2,000, which represents an asset prepaid rent for January and February of the upcoming year. They show you that entry there in the tan box, rent expense, $1,000 prepaid rent. And then they show you the T accounts there in the general ledger, the effect on them. Okay. So now everything as far as prepaid rent is good, or as they used to say in my day, hunky-dory. Office supplies. They have November 3rd, they got the $500 of office supplies on account. They paid $300 and they still owe $200 on it. So we're looking at office supplies on the general ledger account, and we see $500. We got to think, when we bought it, that cupboard or closet wherever we had the office supplies was full. Now it's not full. In fact, it's very little left there. So it tells us down here, during November and December, e-learning company used office supplies to conduct business. Used. What does that say? First, like it's an expense. They use something up. It's consumed. All right. So let's see. The cost of supplies is to measure supplies. We have to count how much office supplies on hand at the December. This amount is still on hand, so it's still an asset. Assume that office supplies costing $100 remain. So that's what the balance of the account should be. So it has $500 balance in it. So we're going to have to reduce office supplies, the asset, by $400 and debit supplies expense for $400. Okay. Be careful with office supplies. Sometimes, and I don't know if we'll see this in the exercises because I didn't do them yet, and it's been 6 months since I did them last semester. Sometimes they will tell you how much was used. If they're telling you how much office supplies were used, that's the amount of the expense. If they're telling you how much is left on hand, you have to compare that with the balance in the account, take the difference, compute the difference, and that's going to be the expense. So that's a little tricky there. You got to watch out what information are they giving you? How are they presenting the information? Are they telling you the ending balance and you have to compute the expense, the amount that's been used, or are they telling you the amount that has been used and then you don't have to compute anything? The next one here that is deferred expense is depreciation. There's a chapter 9. We're going to get into this more, but for now, they're going to give you what the depreciation expense is, and you just have to write the adjusting entry, which would be a debit to the depreciation expense hyphen whatever the asset is being depreciated, and a credit to account called accumulated depreciation slash whatever the asset is being depreciated is called. Depreciation is a method of allocating the cost of an asset that has a life longer than 1 year over its useful life. Okay. I have to stop. There's something's going on over on the other side of the room. Okay. Sorry for the interruption. Yeah, so for depreciation, that's a standard entry for an adjusting entry. At this point in the game, they're going to give you what the amount is. You just have to know you're going to debit the expense and credit an accumulated depreciation account. The accumulated depreciation account modifies every asset that's designated a fixed asset, and we'll get into that in chapter 4 when we talk about consolidate or classified balance sheets and more in chapter 9. We'll figure out how to compute depreciation. Right now, all you have to know is that you're going to debit the expense account and credit the accumulated depreciation account. The accumulated depreciation account is what we call a valuation account. It is applied against the asset being depreciated. It's a contra asset account, so its normal balance is a credit. All right. Yeah. Well, they get a computation. They actually show you how they compute it there on a straight line basis. You can defer that. Defer until chapter 9. And there's the entry right there on 311, depreciation expense dash furniture. You always have a dash so you know what asset you're referring to. Accumulated depreciation dash furniture. Okay. The accumulated depreciation account, it's kind of neat. And again, we'll see this more in chapter 9. You'll have the asset, if it's a long-term or fixed asset, or what we call depreciable asset. And here's the asset. And then right next to it in the general ledger will be its accumulated depreciation account. Each asset that fits in that category will have an accumulated depreciation account that modifies it. The two of them together will, you'll have a debit in the asset, a credit in the accumulated depreciation. The two of those together will give you what we call the carrying value or book value of the asset. Don't worry about that right now. It's a real account. It's as long as we have that asset, we're going to have that accumulated. And it's kind of neat because think about what's happening here. The general ledger has the asset in it and what we paid for it, what we have invested in that asset, and then the expense of the accumulated depreciation is the expense for the whole time we've had the asset, 3, 4, 5, 20 years, whatever. So at any time we can go back and see what we paid for it, what was the original amount it was recorded at, and then how we allocated the cost over its useful economical life. And they tell you a contra account is a normal balance is opposite of the normal balance of the related account. So here we have an asset uh, being modified by a contra account, accumulated depreciation. So the asset has a debit balance, the accumulated depreciation would have a credit as a normal balance. Down there, they have the assets there, or they have the three accounts: furniture, accumulated depreciation, furniture, depreciation expense, furniture, and that bubble there. The accumulated depreciation account accumulates the depreciation expense. As we'll find out in Chapter 4, revenue and expenses are going to get closed out every period, but the other accounts, the real accounts, will survive from year to year. So the accumulated depreciation account they're showing you here is for the first year of operations. There's only one entry, $300 for the expense for 2024. Each year that furniture is going to be depreciated, the expense is going to, the same amount, whatever the expense account is debited for, the accumulated depreciation account is going to get a credit, but it's going to accumulate each and every year. Okay. And as I mentioned before, they say book value is just the asset less its accumulated depreciation is the book value. Sometimes it's referred to as carrying value. You can think of it, the contra account, as a offset. Sometimes they'll call it a valuation account. It values the asset. In the case, devalues. All right, they show you how it's presented on the balance sheet. There's the building less its accumulated depreciation of $250. So the net amount, $59,750, is in the right-hand column there. That would be the book value of the building. The furniture, you see the cost is $18,000 less the accumulated depreciation of $300. Book value is $17,700. Just a balance sheet presentation. Okay, deferred revenues. Deferred revenues occur when a company receives cash before it earns the revenue. Okay, so the entry would have been debit cash, credit a liability, unearned revenue. Okay, only after we complete the job. Now remember, or our contract, in total, if it's either way, we have to do an adjusting entry. Usually, if it's a contract running for a series of months, you divide the total contract by the number of months. How many months have expired, or how much work has been performed or delivered, and that's the amount we got to reduce the liability, increase the revenue account. Okay. The unearned revenue is a liability. It's also called the deferred revenue. Revenue associated is not recognized when the cash is received because we haven't done anything. We haven't performed our part of the bargain. So let's see what they tell us here. Oh, come on. Okay. Law firm engaged Smart Touch Learning to provide e-learning service for the next 30 days, agreeing to pay $600 in advance. So you debit cash for $600, credit unearned revenue for $600. That we got paid on December 21st. Okay. So the last 10 days of the month, December 22nd through December 31st, will earn approximately 1/3. So 1/3 of the $600 payment is now earned. So we have to reduce the liability because we fulfilled part of it and transfer it from a liability account to a revenue account, getting it off the balance sheet and onto the income statement. So they show you the entry there, December 31st. Debit the liability account called unearned revenue to reduce it, $200, transfer it to a service revenue account for $300. Reducing the liability, increasing the revenue. Reducing something from the balance sheet, increasing something on the income statement. Let me show you the T accounts there after they post it, what it looks like, how it affects the balances. Okay. Cross your fingers. I'm trying to turn pages. Oh, hey, it worked this time. Hallelujah. Accrued expenses. This is a type of expense that has been incurred but not yet paid for. The classic example is payroll. Okay, salaries expense grows as the employees work. Okay, usually this happens when the payday or pay period is bisected by the year end or the period end. Okay, accrued salaries. Let's see what advances. Yeah, okay, good. It's working. And they have a calendar there. I use a calendar when I put it on the whiteboard. Now let's see what the details here are. Smart Touch Learning pays its employees monthly salary of $2,400, half on the 15th and half on the first day of the next month. Okay, so they pay them after the employees work. Well, the employees working are the incurring of the expense. So any pay on the January 1st applies to the 16th of December through the 31st of December. Okay, they're showing us here the 15th December is a payday, and January 1 is a payday for the month of December for the employees of what they earned during December. Okay, so how much, if you look in the cash basis, when they pay them on the 15th, that's only half a month. What about, I said, the last half of December, the 16th through the 31st, the employees work, they just haven't been paid yet. They will get paid on January 1st. That's company policy. We pay on the 15th and the 1st. So here's an expense that has been incurred. The employees have worked. They just haven't been paid yet. Okay, so they show you the regular entry there on the December 15th, salaries expense getting a debit, and the employees getting paid $1,200 credit. Now on December 31st, we want to get that second half of December's pay recorded as an expense because it was incurred in December. So we're going to again debit salaries expense for $1,200, but their employees aren't getting paid until January 1st. Well, that's next year. Yeah, it's only a day away, but it's in a different time frame. So we're going to recognize the fact that we owe the employees for the second half of December. So we're going to say salaries payable, and we're going to credit salaries payable for $1,200. I don't know if they show you here or not. Yeah, you scroll down there and they show you what happens. On January 1, when we pay the employees for December 16th through December 31st period, we're not incurring an expense. We already booked that expense in the adjusting entry. What that payment on January 1st does, it satisfies the credit that went along with the adjusting entry. We've made good on our liability, our obligation to pay the employees. So it's going to be a debit to salaries payable to reduce the liability that we created when we did the adjusting entry, and a credit to cash. Okay. Look at that bubble, like a cartoon bubble with the arrow going up to that entry. Don't confuse this entry with an adjusting entry. This is the regular payment of cash on January 1st, the regular payroll. Okay. Adjusting entries are recorded only at the end of the accounting period and are used to record either revenue earned or expenses incurred, deferred or accruals. The entry is a journal. This entry is a journal entry. It is simply recording an everyday business transaction, the payment of salaries. Okay. So you can read the rest of that bubble. Accrued interest expense. Okay. Borrowing money creates an additional liability for a note payable. Okay. Remember that they borrowed a $60,000 note payable to get the building, to get the loan for the building, and they signed a 1-year loan. Wow, that's a lot of money to pay off in 1 year. So we got to calculate the principal, the interest here. Wow, they show you $60,000, 2%. So they got a low rate. This is obviously written before inflation hit, and it's for 1 year. So 1/12 of that, because the interest rate is always given as an annual rate. So you take 1/12 of that. So we have $100 interest. Now the interest is going to be paid probably at the end of when the note payable comes due. We're going to have to pay the $60,000 back plus 2%. That'd be $1,200. So they're going to have to pay back $61,200. But part of that $1,200 interest is applicable to December 2024. Okay, they're going to have to pay the note off in November of 2025. So we have to do an accrual, an adjusting entry to record the interest that's applicable to December of 2024. They did the calculation for us. Thank you very much. All we have to do is debit the interest expense account for $100 and credit interest payable. And I don't know if they show us here what happens when you pay it off. Part of that will reduce the payable and then the $1,100 expense for 2025. I don't, I hit the arrow and it takes like 3 seconds. It's frustrating. I apologize. Accrued revenues. Okay. I'm going to start with the second paragraph down there. Smart Touch Learning is hired on December 15th to perform e-learning services beginning on December 16th. Under this agreement, the business will earn $1,600 monthly and receive payment on January 15th. At the date of hiring, Smart Touch Learning does not record a journal entry because revenue has not yet been earned. Okay. Nor, let's see, they will earn half a month's fee. Okay. So, did it say when we're going to get paid? No, yeah. We'll probably get paid on, and receive payment on January 15th. So we entered a contract to go from the middle of December to the middle of January for $1,600. No entry was made because we didn't get payment and we haven't done anything. December 31st, these are one of the hard ones to catch. December 31st, we've fulfilled half of the contract. So we're entitled to record half of the revenue. Well, we're not getting paid. Well, we got to pick up half payment. So we're going to get paid January 16th, but we're at December 31st. So we have to do an adjusting entry to accounts receivable for half that amount, $800, and service revenue. A revenue account is credited for $800. Okay. Later on, they show us what happens. We get the payment of $1,600 on January 15th. Half of it, $800, is applicable to January. The other half reduces the account receivable we recognized when we recorded half the revenue for this December portion of the training. Again, slow down and think about all these things. It's just logic and trying to get the thing in the right time frame, whether it's an expense or a revenue, and then the corresponding offset. They give us a summary of the ones I just talked about there with all those X's. Here's an important thing to look at in that, I don't know if this is marked. Yeah, Exhibit 3-3, Exhibit F 3-3 on page 319, according to my book. They give us a summary there. The important thing I'd like to call your attention to is over in the bottom left-hand corner, accruals, cash receipt, or cash payment occurs later. 2 rules to remember about adjusting entries. This is a circle there in the lower left-hand corner again. Adjusting entries never involve the cash account. 2, adjusting entries either increase a revenue account or increase an expense account. Okay? 2 important things to keep in mind there. Okay, so we would write all those journal entries that they give us there and then post them to the general ledger, which they're showing us in panel C. And they highlight the amounts of the, in my ebook, they're a different color, so you can see the adjusting entries being posted. Something just popped up in here. I'll get rid of it. Made it the whole page. Okay. And they give you a thing to work out there. All right. Let's see if I can turn the page again. 1, 2, 3, 4. All right, 4 seconds. I guess I need patience as a virtue. What is the purpose of the adjusted trial balance? How do we prepare it? Okay, we saw a trial balance before. All it is a listing in the general ledger that have a balance other than 0. Okay. So now that we've done adjusting entries and posted those to the general ledger, that trial balance is no longer valid because we've changed certain accounts because of the adjusting entries. So we have to do another trial balance, and we're going to call this, guess what? The adjusted trial balance. So after we do the adjusting journal entries, we're going to post those adjusting journal entries to the ledger accounts, general ledger accounts, recompute the balance of the accounts because we have increased certain things and decreased certain things, and then do another trial balance, but it's going to be after the adjusting entries. So it's called the adjusted trial balance. And again, all it does is prove that debits and credits are equal. Doesn't mean we didn't make a mistake elsewhere. And they show us the one there, the adjusted trial balance. Now, there are accounts that appear in the adjusted trial balance that we didn't see in the trial balance because sometimes we have to add an account. Some of these payables weren't appearing in the adjusting entry. We didn't have the depreciation expense appearing in the regular trial balance. So yes, you have to add the accounts. Again, they will be, if when we write the journal entries and we go to post them, if there's not an account there, we have to put insert an account in the general ledger. General ledger is a flexible thing. It can be increased or decreased, usually increased as the business grows. You're going to have more accounts. And another example there. Oh, all right. I hit it, waited for it to change, and hit it again, and I want 2 pages. That's my bad. What's the impact of adjusting entries on financial statements? Well, it makes them paints a truer picture, a fairer picture of the balance sheet and the income statement, which is going to impact the statement of cash flows and statement of retained earnings. Okay. Okay. Figure 3-6. They go over the 4 types of expenses, or I'm sorry, 4 types of adjusting entries: deferred expenses, deferred revenues, accrued expenses, accrued revenues. They give a description there, what the entry would look like in a generic format, and then what its impact on the financial statements would be. Now, like underneath there, what I alluded to earlier in this tape, remember net income increases retained earnings, an equity account. Therefore, the net income is overstated, then equity would be overstated. If net income is understated, equity would also be understated. That's why we have to do these things. We want to get a good measure of the business firm's financial profile. I can walk you through an example there. Again, you can do that. I'm not going to take time on the tape here. They have one more thing here, or a couple more things left here in the chapter, and it's a worksheet. I usually have my accounting majors do the worksheets. All it is in an Excel spreadsheet, depending on Excel. What it does is it lists all the adjustments and then updates the accounts. You do the adjusting entries. You have the trial balance with its 2 columns, and the next 2 columns you'll have the adjusting entries with your debits and credits, and then you have the adjusted trial balance columns. And again, the rule is if you have a debit and a debit, you add them. If you have a credit and a credit, you add them and bring them over to the appropriate column. If you have a debit and a credit, you subtract them, net them out. If you have a credit and a debit, you net them out, subtract them. Okay? So it's a useful tool accountants use to summarize things. And they show it there, and you can see you got all the accounts listed down the left-hand side, and you have in column A, column B and C is the unadjusted trial balance. Column D is just used for the reference for the adjusting entries. Columns E and F are the actual adjusting entries being posted there. And column G is a reference for the adjusting entry letter designation. And then columns H and I are the adjusted trial balance. Debit and credit column. Look at line 2 for the accounts receivable. It was $1,000, and there's an $800 debit for that one adjusting entry H. So now that, since it's a debit and a debit with an asset, you bring it in as a $1,800 debit. Accumulated depreciation on line 13 there was nothing in the, it didn't appear in the unadjusted trial balance, but it has a credit from the adjustments, and it comes over as a credit in the adjusted trial balance. The corresponding expense would be down the bottom, depreciation expense. Accumulated depreciation and depreciation expense will always be offsets. So up the top there, the accumulated was on line 13 was a credit. So we'll find letter D in the left-hand column, and there it is, a debit to depreciation expense. Okay, now those last 4 columns, you see 2 are the income statement and 2 are for the balance sheet. And again, columns for debit and credit. Now we just bring the numbers over from the adjusted trial balance over to those 2 columns. So the first one that has to be done is the income statement, because we have to figure that for the retained earnings. And you'll see how that, I don't know if they showed that here as the next chapter, the completed one. Come on. Yeah. I hit it twice. For everyone knows that. Oh, I'm in the appendix. All right. I wouldn't worry in the appendix about they talk about reversing entries. So that's a thing of convenience where people don't want to do you can do your normal payroll entry. If you do a reversing entry, it just sets up the, you really don't need to do it. It's an optional or an alternative way of doing it. So you can pretty much ignore it at this stage of the game. So I think that pretty much wraps up the chapter. Later on this week, I will do another video going over the assignments from the end of the chapter. Okay. And I'll also be getting back with your exam results.